Welcome to the World Lens podcast, where each week we look at news from around the world through a global business lens. I'm your host, Michelle Evans, Digital Specialist at the World Trade Center Institute. So, first today we are talking about another topic that you suggested. It's one that will intersect with one that we've already discussed in the past, which was climate change. So today we're going to be looking at insurance, specifically home and business insurance. Insurers are increasing premiums and also pulling out of some states entirely. Why is this happening, Bruce? If an insurer leaves a state, does that mean you just aren't making profits there anymore, or are you just losing money?
Yeah, so I suggested this because I've worked with the insurance industry for over a decade, and primarily in the property and casualty arena, and
Mm-hmm.
then sort of that experience with them and reinsurers, and then the whole issues of climate change and terrorism and other things is why I suggested it, because I felt like it would.
Mm-hmm.
So really what we're talking about today is more around the property and casualty piece. So,
Mm-hmm.
an insurer or a carrier can pull out of a state on certain types of insurance, but still do auto and other things, right? So,
Mm-hmm.
but anyway, so the answer to your question, aren't they making profits anymore? I would say that losing money or the likelihood of continuing to lose money is a good reason why
Yeah.
an insurer would pull and discontinue what we call underwriting, right? And just
Mm-hmm.
say, we're not going to accept any more risk in this location. See you later. And so that's definitely the key motivation.
So California has seen insurers leave, citing increased wildfire risk.
Hmm.
Florida, New Orleans have seen the same, but for flood and hurricane. What
Hmm.
happens if there aren't any more options? You can't just like not have your home insured, right?
Exactly. So if there's no other option, then yes, your property would not be insured. Right now, most of the times the carriers will honor the book that they have, the policies that are there, or they
Mm-hmm.
may have a phase out period, right? But yes, at some point, you would, not have funds to do that. And it becomes really complicated because things are linked, right? So if I have a mortgage,
Mm-hmm.
my
You have to have
lender
insurance.
requires insurance
Mm-hmm.
because they're at financial risk on that asset, right? And so if something
Mm-hmm.
happens to it, they want to make sure that it's repaired so it withholds the asset that they're intending to get, the mortgage paid if you default, right? So if
Mm-hmm.
you don't have insurance, then you are, in default, and the lender can foreclose on the property and get some, some value out of it and be done, right? So
Mm-hmm.
it's an ugly situation.
So, for example, say I find my dream house in California, somewhere near a beach, and I'm ready to go to closing, but I cannot get home insurance. Will I just kind of not be able to have my house?
So
Is
the
that what's
lender is not
happening?
trying to bind that, no.
That's crazy. So, if insurers are pulling out of states, does that mean whoever's left gets to kind of scoop up all the business? Wouldn't they like make more money, or are the disasters causing like too much damage?
Insurers do not like to scoop up all the business. Okay, there's a thing called risk concentration, right? So if I'm the sole insurer of an area
Mm-hmm.
and a tornado comes through and wipes out, 250
So
properties,
a lot of claims.
I'm the only one writing checks, right? So no, we don't like that. If there's 10 insurers, then I'm going to be writing a portion of that, those checks. And so they don't like they don't like that. They like to spread that risk, both
Yeah.
geographically but also financially, right? So the way the insurance market works is you have like the primary insurer, whether it's Allstate or Erie or whatever,
Mm-hmm.
it's there. But then the insurers have insurance. It's
Right.
called reinsurance, right? So that they're going to take like a limit that says, okay, for this type of insurance that I'm writing, I'm going to take up to I don't know, $20 million in law, or not loss, but in uh, payouts.
Mm-hmm.
And then above that, I'm going to go to a reinsurer to do my excess, right?
Mm-hmm.
And that's because, banks don't sit around and have $100 million of money sitting around, waiting for a problem to happen, right?
Right.
So the reinsurers, ensure that they've got liquidity and can deal with the problem. So that's really, what's happening. And so, with this, there's um, the costs that of all of this. It's like, okay, well, I've got to pay out to replace that property, which all, the property costs, the services costs, and material costs, and everything have increased. So all that's driving, more and more cost. That many times these insurers, said, well, the replacement value of this home is X, but then when they actually get to it in real life, it's
Mm-hmm.
2X,
Yeah.
right? But they've insured replacement costs. So that's the kind of risk that they're running into, and in underwriting, that's causing a lot of pain.
Yeah. I saw a story where one family went from paying like $1,700 annually to about five. It's like at that point, that's a lifestyle change. And what happens, like we mentioned, it's connected to global change, or climate change, because all these like events are happening, hurricanes, wildfires. What eventually is going to happen when we can't control it? And the insurance companies are like, all right, we're out.
Yeah, so we've been there before. And this was in the 60s when government, the country,
Mm-hmm.
established what was called the National Flood Insurance Program, right?
Mm-hmm.
And actually worked on this in the 70s, in my first job with doing working in computers and stuff, was around it's called NFID, but anyway, NFIP. The thing is that when they looked at this, they said there's two issues that we have to deal with when we're in a situation like this. We can't just look at protecting the property and the financial value of the property.
Mm-hmm.
We've got to have an equal or bigger effort on how do I reduce the risk of flood damage to minimize the amount that I'm paying out to deal with it, right?
Mm-hmm.
So this reducing the risk within property and communities is a much more governmental responsibility. And
Mm-hmm.
the incentive of the government to do that and to invest in flood control and flood mitigation, if they're having to pay out on the other end, they have a complete financial model of making those decisions. That was kind of the big picture of what was there. And we may be heading that way, because it's not just flood, it's not just fires, it's tornadoes, it's heat,
Mm-hmm.
it's all, all kinds of things. You know, it's I heard them talking about, lemon size hail today, coming in. And so just having property and pelted with that kind of stuff just pulverizes it, right? Vehicles, hundreds
Yeah.
and thousands of vehicles that are damaged. So in this, and the other challenge is that a lot of times the premiums are based on historical losses due
Mm-hmm.
to hazard, right? And now they're, luckily, and a lot of them are starting to look at projected, like where is this going, what's the trend line for sea level rise, for severity and frequency of storms. And look at the
Mm-hmm.
National Weather Service said, look, we're likely going to have like a horrible hurricane season ahead, right? And that's when insurers, shaking their boots, because it's like, oh no. And so, yeah, so I think there will be uh, a national powwow that says, how do we start to address what's coming at us in the
Mm-hmm.
next 30 to to 40 years.
Yeah, like the legal side of things, like I mentioned before, you kind of need insurance in order to get a
Mhm.
mortgage. But what if you've paid off your house and you kind of don't need it? But do you think we're going to see a time where home insurance is no longer like an expected standard to have?
So, yeah, so if you own your home outright, then that is a risk financial decision
Mm-hmm.
that you make personally.
Right.
And again, I would be looking at a homeowner saying, oh, you don't just like not make that $2,000 payment or $5,000 payment or whatever it ends up being. Not probably not five, but anyway, but say, okay, if you're not going to do that, then what you should do is take some of that. Like, let's say it's I don't know, $10,000 a year is what the insurance was called. Okay, take five, like
Mm-hmm.
$400 a month and put it
Put it
in,
away.
a low risk, interest bearing, so that in 15 years at 5%, you might have, I don't know, $50,000 there,
Mm-hmm.
right? Or if it's 10 years, you might have, I don't know, $20,000. But at least you'd have something to deal with, not
Mm-hmm.
catastrophic loss, but at least damage, and be able to, repair your home and that kind of stuff. But not just say, oh, I don't have to pay it anymore because I don't have a mortgage. That's not the right thinking. It should be,
Yeah.
what can I afford to pay to because that's
Make
an
sure.
when it's in your bank, it's your asset. When you
Mm-hmm.
give it to the insurance company, they're putting it in their bank, playing the same game, right?
Mm-hmm.
And but now that's their money. You never see it again. So in reality, you're actually paying yourself, but you're building that nest egg that you can tap down the road. So you're being your own
Mm-hmm.
insurer.
So far, there are a few geographical outliers where this has been happening. So, what happens to the housing markets in those regions? You can't get a brand new house, insured because you can't take the loan. But does that mean that there are just a bunch of empty houses in this like certain regions because there are no insurers?
First off, is due to climate change, there are fewer outliers. Okay. And get it. I mean, just look at the news in the last months, with tornadoes and here and
Mm-hmm.
there and there, and Texas is on fire, and
Yeah.
Houston's, everyone's running around in boats instead of cars, So yeah, so this is our new reality, and it's I've been, one of the reasons I suggest this, I've been talking to people about this for over a decade, and we were already seeing where things were going, and the situation now, and we've seen it, all the coastal areas of the US are going to be impacted, right,
Yeah.
at some level, either consistent inundation just because of sea level rise, or more importantly, when there are storms, you're going to have more inundation and obviously damage, right? So you have that going on. So in this, what I would say, kind of by 2050, uh, it's going to be incredibly problematic. Well, that's 2050 is like a typical 30-year mortgage, right? So
Mm-hmm.
now, 10 years ago, it seemed far out, but now it's like you're buying properties and you're getting a 30-year mortgage, and we're looking down 30 years saying your house could be gone.
Mm-hmm.
Well, how does that work, right? So, you know, I've been telling people for a decade now to, when you're prepared to like purchase a property, you need to go look at this and
Mm-hmm.
open the aperture and say, and there's FEMA, there's the USGS, there's commercial sites where you can actually put in the property address and it'll tell you what is your future risk, right?
Mm-hmm.
And and there's parts of Florida that, especially in the lower third of Florida, that by 2050 is substantial risk. In 2100, 2000, 100, that might not even be above water, right?
Mm-hmm.
Depending on where things go. So it's like, okay, is that really what I want to be doing? Likewise, if you own a home, you should be looking at this and saying, just like the insurers, what's it look like down the road, right?
Right.
should I be, and that was part of the conversation 10 years ago, that maybe you should look at your property before it's difficult to sell it or you can't get insurance.
Right.
Obviously, we're there now, but still people should be evaluating and saying, what am I going to do? Because you can thoughtfully migrate
Mm-hmm.
or you can be forced to migrate. It just depends on your horizon.
Yeah.
Mhm.
So it doesn't look like anyone's planning to retire in Florida anytime
I
soon.
think Florida is still a hot place to retire. In the upper two-thirds of the peninsula, there's still high ground. And yes, in 30 years, you might have beachfront property. More power to you. Kind of like an earthquake in California. But again, not it's not funny because people need to go in with their eyes open, right? And
Yeah.
a lot of these properties, people will go and buy them outright because they sell a home in a big market, and then they go and they purchase it outright so that they don't have a mortgage to deal with, so therefore they don't have an insurance requirement.
Mm-hmm.
And unfortunately, a lot of people just don't look at and think about that
The
aspect
future.
could be
Yeah.
wiped out.
So if insurance becomes too unstable, is there a situation where the government could possibly step in with like a federal plan or some state specific plans?
So that's what I was saying before, which I
Mm-hmm.
do feel like we have to come to the table and really look at what's going on here. If we, as we look forward, just like we did with flooding, that it's like, yeah, there's wildfire risk. Well, who can mitigate that risk, right? So
Mm-hmm.
to some degree, the power companies that have transmission lines and those kinds of things are doing a lot of vegetation management and that kind of stuff to try to limit their you know uh, hazards as far as their
Mm-hmm.
them starting a fire. But that's just a swath, that's not the whole problem, right? So again, it becomes more of like a governmental role to say, okay, how do we mitigate? What do we, do regulations and laws around property owners that they have to do clearing and whatever, right?
Mm-hmm.
And the utilities and other, starting to have the government help mitigate these so that we can reduce that. And then the other part of it is early detection, right, and response. So there's technology out there now that you can like deploy sensors, out into like a large forest area that will detect, and it's almost like a skier that pushes a button or has a fall, and it transmits up to the satellite, that
Mm-hmm.
search and rescue signal. These things will click off and say, hey, I have elevated heat, and you can dispatch a drone and put that heat out, whatever it
Mm-hmm.
is, in a very localized small area like that. We have
Nice.
that ability today, and it's being deployed in Greece and elsewhere. But again, that's a huge capital investment. But if we
Mm-hmm.
could do that and literally nip this in the bud before it becomes a 300,000 acre problem. But again, who's going to make those investments? We are, as a collective, not an insurance company or a homeowner, right? So I
Mm-hmm.
do feel like that's the end game here, that we're going to see a lot more state and governmental partnering with insurance
Mm-hmm.
to, and maybe not take over the market, but just like in the flood, they're going to take
Yeah.
on
Help out.
responsibility for mitigation and response, that gives the insurers confidence that they're not going to have huge claims.
Payouts. Mm-hmm. Does this have a knock-on effect on home ownership? Is renters insurance skyrocketing too? Even though I'm pretty sure renters insurance is like pennies compared to
It's
homeowners
pennies, and it
insurance.
doesn't cover anything. Yeah,
That too.
most renters insurance covers your personal effects,
Yeah.
not the
Not the
building. Or,
structure.
yeah, and most
So is
people
that
like that.
another cost that suggests renting is easier or cheaper than buying a house?
Yeah, so if we're going to look at it from the whole issue of insurance, no,
Mm-hmm.
because landlords have to insure their homes
Mm-hmm.
or their properties, right? for you to live in it, and so they're paying the insurance, which means that cost is going to be levied on the renter. So if this is an insurance driven thing, then wherever you're renting, you're going to be absorbing those increases in insurance costs for that property. I think the other knock-on effect, I guess, if I looked at it and said, okay, if a landlord is just a person, right? They have houses, they have to pay all this insurance, or they can't get
Mm-hmm.
insurance or whatever. So if supply decreases and demand even remains the same, costs are going to go up, right?
Yeah.
Because there's less, units to rent. So yeah, I think it's renting becomes problematic, even especially in an environment where insurance is either unavailable or very, very expensive. It's going to be felt by a renter.
All right. So let's dust off your crystal ball. 5 years from now, where will we be? I mean, I know there's going to be more climate change because, data suggests it, but will there be fewer insurance companies overall? Will there be fewer homes protected? What are we seeing in that crystal ball?
Well, in the next 5 years, there's no question. This is an easy crystal ball. There will be continued disruption in insurance markets. Okay, um, I think my crystal ball would be more on a 10-year horizon, that yes, there'll be more disruptions, more homes that are lost to climate change and weather issues and everything. And yes, more insurers will pull, underwriting for certain policies,
Yeah.
lines of insurance. In a 10-year period, the government will have to, or the states, in their insurance regulation, but I would say the federal government is going to have to address this. And, it's not going to happen overnight. That's why I put more of a 10-year horizon to say that, that they're going to have to step in. And, I think in the beginning, they'll try to do it through utility and property regulations. To be a property owner in a particular state, county, whatever, you have to take on certain responsibilities. But at the end of the day, a lot of these are out of the owner's control, right?
Mm-hmm.
Tornadoes and things like that. So,
Yeah.
but also, you look at these, and there are like design build standards that will withstand, Cat 5 hurricanes and things, right?
Mm-hmm.
And you see it sometimes when you see pictures of like housing areas where there's 5 buildings that look like they weren't touched and all the other
Right.
ones are flattened, right? So building codes and all those kinds of things. So 5 years, more disruption. 10 years, I think we're going to see more addressing of these issues in all the things that I just talked about to try to
Mm-hmm.
mitigate the impact to people and property.
So hopefully by 2100, home insurance won't just be a term in a history book.
No, and flood insurance isn't either. But again, just in closing, and I've been said this for the last decade or more, I cannot stress more that a homeowner or home buyer needs to factor in climate change within their holding period when they're making a buying decision or
Mm-hmm.
purchasing or selling decision. And that's got to be part of your consciousness and part of the effort. It's, yeah, the beautiful home sitting on a cliff in California might not be a good idea, right?
That's good
And unless
advice.
unless money's no object, then that's your decision. But for most people, it is.
Yeah,
So,
that's really good advice. Well, thank you, Bruce, for joining me today. And of course, thank you so much for tuning in. Please visit the World Trade Center Institute online at WTCI.org for more insights, events, and opportunities. And make sure to follow us on all social channels at WTC Institute. We'll see you next week.